Before we begin, let us ask a serious question. Why does a financial system that moves trillions of dollars every day suddenly freeze in fear? The center of global finance is Wall Street in New York. Every day, more than $7 trillion moves through global financial networks connected to this district. This immense volume of capital flows through investment banks, hedge funds, and sovereign wealth funds, trading assets worth hundreds of billions. For decades, Wall Street appeared unstoppable, a powerful, seemingly invincible engine driving the very core of global capitalism. However, history shows that even the most powerful financial systems can suddenly stop breathing. The silence can be more deafening than the chaos. One of the most shocking moments occurred during the 2008 global financial crisis, a moment that redefined our understanding of systemic risk. On September 15, 2008, the investment bank Lehman Brothers declared bankruptcy. It was a pillar of the financial world that many thought was too big to fail. The institution had existed for 158 years, weathered countless storms and shifts in the market, yet it collapsed within a matter of mere days. At the time of its failure, Lehman Brothers held liabilities of approximately $613 billion, nearly $800 billion in today's value. This single collapse triggered a wave of panic across the entire global financial system, exposing the deep interconnections we often take for granted. Banks stopped lending money to each other. Credit markets, the lifeblood of our economy, simply froze. The trust that holds everything together vanished. Stock markets around the world plunged. For several days, the global financial system appeared to be completely paralyzed, unable to function. It was a moment when Wall Street seemed to stop breathing. But as we reflect on that history, we must realize the danger has not disappeared. It has merely changed form. The financial world is now facing a new type of crisis. This time, the danger comes from the rapidly growing market of private equity and private credit funds. Private funds collect capital from investors and invest in assets such as corporate loans, infrastructure projects, real estate, and private companies. Over the past 2 decades, this market has grown dramatically. Today, the global private credit market alone is estimated to be worth about $2.6 trillion. The problem lies deep within the structure of these funds. They invest in long-term, illiquid assets that cannot easily be sold in a hurry. However, investors can demand withdrawals when they become nervous. This mismatch between liquidity and investment duration creates a profound systemic risk. Recently, this risk became highly visible. We began to see the cracks in the foundation as large funds faced unprecedented pressure from their investors. A large private credit fund connected to one of the world's largest managers faced redemption requests of approximately $1.2 billion. Because the fund's underlying assets could not be quickly sold, the firm was forced to restrict investor withdrawals, trapping capital when it was needed most. In another case, a global real estate investment fund faced redemption requests exceeding $1 billion, forcing them to delay withdrawals for many investors. These events reveal an important truth about financial markets. Beyond the numbers and the data, there is a far more human element at play. Financial systems may appear to operate through numbers, algorithms, and financial models, but in reality, they are sustained by human psychology and trust. When markets rise, investors become optimistic. Rising prices create a sense of confidence, and that confidence attracts even more capital into the system. But when uncertainty appears, optimism quickly transforms into fear. And fear, as history repeatedly proves, spreads much faster than confidence ever could. And once trust disappears, financial markets can suddenly freeze. That is the exact moment when Wall Street holds its breath and the world waits. Similar events have occurred in other countries as well, proving that these structural weaknesses are not confined to a single geographic region. In South Korea, the Lime asset management scandal led to the suspension of redemptions worth approximately 1.6 trillion Korean won. Another case, the Optimus Fund scandal, involved about 500 billion won in frozen investments, further shaking investor confidence in private products. These incidents shocked investors and highlighted the structural weaknesses in private investment products that many had overlooked for years. The lesson from these events is clear. Behind every promise of high returns lies an invisible, often ignored layer of significant risk. The core insight of my book is simple but powerful. Financial crises are not merely failures of money. They are, at their heart, failures of trust. When investors lose confidence in the system, markets stop functioning normally. The mechanisms we rely on daily simply grind to a halt. Therefore, the book delivers several key messages. First, financial markets do not rise forever. Cycles of boom and collapse are inevitable. Second, risk often grows in places where it is least visible. Many crises emerge quietly, in the shadows, before suddenly exploding into the light. Third, long-term thinking is the strongest investment strategy. Short-term greed exposes you to danger, while disciplined patience creates true resilience. Through this story, readers can gain three important changes in perspective. First, you will understand financial markets more deeply, recognizing the psychological forces. Second, you will learn to view crises not only as disasters but also as predictable patterns in economic history that we can prepare for. Third, you will develop a more rational approach to financial decisions, relying on firm principles rather than the sway of passing emotions. The history of Wall Street is not simply a story about money, it is a powerful drama shaped by human ambition, fear, and belief. And that drama continues even today, as we navigate the complexities of a globalized, digital economy where trust remains the ultimate currency. The message of this book can be summarized in one sentence. Markets appear to move with money, but in reality, they move with trust. If you enjoyed this video, please press the like button. It helps us share these important insights with a wider audience. Thank you very much for your time today. I sincerely wish you happiness and success in everything you do. Until next time. To truly grasp the scale of Wall Street, we must look beyond the ticker tapes to the underlying connections that bind us all in this global web. This structure is far more fragile than it appears, a house of cards held together by our collective belief in its continued stability. My book is more than a history, it's a guide for the future. I hope it serves you well in your journey through the ever-changing markets. The world of finance never stops moving, but it's our trust that keeps the gears turning. May your decisions be guided by wisdom. Thank you once more. Stay informed, stay rational, and always remember the power of trust. Goodbye for now, and good luck in all your ventures.